I've actually seen the damage that these new HMRC checks do to limited companies and the self-employed because I advise hundreds of businesses every single month. In 2025, HMRC doesn't guess anymore. Their sophisticated AI system tracks your online activity, including your social media, and then cross-checks it with what your bank, e-commerce sites and crypto platforms have already reported to them. So not only am I going to share my hottest tips for how to keep you safe from destructive HMRC investigations, I'm also going to tell you how to keep more of your cash away from them. Let's start with the most important and frankly most dangerous reality in this video. Right now, HMRC is using an artificial intelligence system called Connect, and it's not just looking at your tax return, it's looking at everything. According to HMRC's own disclosures under the Freedom of Information Act, their Connect system actively scans your bank account activity, payouts from PayPal, Etsy, Amazon, Stripe, Airbnb, the land registry as well, DVLA records, and yes, even your social media. They literally use social media to assess your lifestyle and check if it matches what you're declaring. So if you're posting from a hot tub in Marbella, showing off a new Tesla, or filming content in your mansion with a "grind never stops" caption, whilst you're also declaring 30 grand profit and claiming mileage at the flat rate, you're not under the radar, you're right at the top of their list. A senior HMRC official confirmed in 2023 that Connect flags discrepancies between declared income and known lifestyle indicators, such as expensive assets or international travel visible online. And here's the kicker: you don't need to be committing fraud. You just need a lifestyle that doesn't match your tax return, and HMRC will open an inquiry to close the gap. Before I talk about how to protect yourself from their AI system, I want to know what you think about HMRC being able to do this. Pop it in the comments below. Is their system overstepping everyone's right to privacy, or is it a necessary evil to ensure that people are held accountable for the tax they owe? So, how to protect yourself from their spying AI eyes. First, declare everything. If you've made money through online platforms, whether it's selling mugs on Etsy, side hustles paid through PayPal, or affiliate links from TikTok, declare it. Since 2024, all those platforms are legally required to report your income straight to HMRC. So if you leave it off, HMRC won't just suspect you've underreported, they'll already know. Second, track your income properly. Use proper accounting software, like Xero or Free Agent, QuickBooks, or even our free spreadsheet, and we'll put the link in the description. But whatever you do, don't rely on your memory. Every deposit, every client payment, every PayPal transfer, record it, because the more complete your records are, then the less HMRC have to fill in the blanks themselves, because whenever they do, it's never in your favor. Thirdly, explain any luxury items. If you're driving a shiny new car or living in a house that doesn't seem to match your declared profits, just keep a simple explanation on file. For example, was it bought on finance? Was it a gift? Was it purchased or bought personally and not through the business? You don't need to include this in your return, but again, if HMRC ever asks, you've got your answer ready. And then fourth, be mindful of what you post. Seriously, really, you can absolutely be proud of your success, but don't post 6 figures in 6 months on Instagram while declaring 18 grand of trading income. HMRC sees it, they match that to your tax return, and if it doesn't add up, you'll be explaining it under investigation. And if you want to be really cheeky, most social media apps like Instagram give you the ability to private your account. This can actually limit the information HMRC can access, but you shouldn't rely on this as your only defense. HMRC will still be able to see photos you've been tagged in and even comments or reviews that you've left. Now, I bet some of you watching are probably thinking,
well, none of this really applies to me. I only make 3k from my e-commerce side hustle and everything else is taxed at source.
well, that idea that you can fly under the radar because you're just starting out or only making a bit on the side is exactly what gets people into the most trouble. Because here's the truth in 2025. HMRC is targeting small traders more than ever. And why? Because if you're a sole trader, side hustler, or small business with no accountant, no payroll, and no VAT, your return is simple. And simple means quick to check, easy to compare, and cheap to investigate. In other words, a quick win. Let's say you're selling on Etsy or TikTok Shop, doing freelance jobs through PayPal, renting out a room on Airbnb, or making digital products on Gumroad or Ko-Fi. All of that income is now automatically reported to HMRC by the platforms themselves under the OECD, got to get that one right, platform reporting rules, which started applying from January 2024. So they don't even need to chase you anymore for information. They've already got it. They just wait to see if you declare it. And if you don't, that's a low effort flag for them. They don't need a full audit team. They just compare what Stripe said and what you said. Even earning £1 over the trading allowance is enough to trigger HMRC's attention if it goes undeclared. Sure, it might not be a full-blown investigation, but it could be a quick £100 penalty letter for late filing. For them, it's easy money, and it's exactly what they need to start filling in that 50 billion black hole you keep seeing all over the news. HMRC doesn't need proof of intent. They just need evidence that you should have filed and you didn't. So register for self-assessment tax returns as soon as you cross that £1,000 trading allowance threshold, even if you don't owe any tax. And most importantly, back it up. Invoices, payout reports, receipts, screenshots, whatever you've got, keep it. If HMRC checks, you'll be glad you can explain your figures in seconds. So we've just talked about how HMRC's AI cross-checks your lifestyle and income. But here's where people really trip up, often without realising it, putting personal spending through as business expenses. And I get it, seems harmless. You think, I work from home, I use this stuff for business, surely it counts. But here's the problem. HMRC has been clamping down on this hard. And why? Because every personal cost claimed as a business expense directly cuts your tax bill. And when HMRC sees patterns that don't add up, they don't just disallow the claim, they assume you're bending the truth. Let me give you a real-world example. We had someone claim $9,000 in marketing spend for the year. When asked for receipts, it actually turned out to be £2,000 they'd spent on a photography holiday, £1,400 on a gaming laptop, £3,000 on Facebook ads with no copy of the campaign or audience data, and the rest, vague influencer expenses with nothing to back them up. And guess what HMRC did? They disallowed the entire £9,000. They added interest on the extra tax owed, and they flagged that director for extra scrutiny the following year too. So how do you stay on the safe side? Well, HMRC's golden rule is this: expenses must be wholly and exclusively incurred for the purposes of the trade. That's the key phrase. Not partially, not sort of, wholly and exclusively. And legitimate business expenses include marketing and ad campaigns with proof that they actually ran, website costs, hosting, domain names, laptops, software and office equipment, business travel, networking events and training, accounting fees, insurance, subscriptions, a portion of your home bills even if you work from home. There's quite a lot of them. But basically, if it helps you earn money and you can back it up, it's probably fine. If you're unsure whether you've declared everything properly, especially if you've been selling on platforms like Etsy, PayPal or Airbnb, don't sit and wait for a brown envelope. We offer a free chat to make sure your records match what HMRC sees. Book a quick call, the link's in the description. So you've declared your income honestly. You've kept your expenses clean. You're thinking, I should be golden, right? Well, not quite, because even if you do everything else perfectly, missing a deadline can still trigger an investigation. In the words of HMRC, late returns increase the risk profile of a taxpayer. Translation, you file late, you go on a list. And it's definitely not Santa's nice list. And it's not just your personal tax return. They're also cross-checking whether your VAT returns are on time, payroll submissions are correct, corporation tax and confirmation statements are filed when they should be as well. All of these systems, the VAT, the payroll, the self-assessment, they all talk to each other. And if there are gaps, HMRC's Connect system notices, so use reminders and automation to keep yourself on top of any filing and payment deadlines. Sure, HMRC sends out email nudges, but don't rely on those. Put it in Google Calendar, set up task reminders, write it on a post-it note and stick it on your kettle if you've got to, because here's the truth. A 30-second reminder can save you hundreds in penalties. And here's another golden rule. If you can't pay on time, still file on time. You'll get in far more trouble for a late return than a late payment. If you owe tax but can't afford it, file the return, then contact HMRC's Time to Pay service. 9 times out of 10, they'll agree to installments as long as your return is filed correctly and on time. If you've got nothing filed, they won't even talk to you. Think of your return like turning up to a job interview. If you show up on time with everything prepared, nobody thinks twice. But if you show up sweaty, flustered, and 30 minutes late, you've already made an impression. And with HMRC, that impression is, this person needs a closer look. So what if you've already messed something up? Well, take a breath, because here's the good news. HMRC punishes dishonesty, not honesty. If you spot a mistake and you come forward yourself, you can often fix it without any penalty at all. But if they find it first, now you're not just wrong, you're hiding something. HMRC splits behaviour into categories. Careless mistakes that are disclosed. These usually fall into a penalty range of 0 to 30% of extra tax. That's right, if you play your cards right, you can actually be let off the hook completely. Then we've got deliberate but disclosed. Slightly higher penalties at around 20 to 70%, but definitely not the worst. Then deliberate and not disclosed. This is the worst case scenario and can usually land you with a penalty of between 35 and 100% of the tax already owed. So the difference between owning it now versus waiting for that brown envelope can literally be thousands of pounds. But how do you make a disclosure? Well, you're in luck, because HMRC makes it nice and easy for you to be honest with their own digital disclosure service. They think of everything. This is called the Contractual Disclosure Facility, get that one, for serious cases, or just a simple correction through your online account for minor ones. You declare what went wrong, you submit corrected figures, you pay any extra tax due. And if you're upfront about everything, you're far more likely to avoid penalties entirely, and especially for smaller errors. One thing to avoid though is trying to patch it quietly in your next return. This is often where a lot of people mess up by trying to do that. That doesn't balance anything. It just makes 2 bad returns instead of 1. Each tax year should reflect what happened during that period. If the mistake was in 23-24, correct that return. If you think something on a past return might not be right, don't panic, but do act. We work closely with HMRC specialists at Vantage Tax who help our clients prepare proper disclosures and respond to enquiries the right way. Book a free confidential consultation. We'll guide you through it. Now, if you like what you're hearing in this and the information you're finding really useful, click subscribe. If you get to the end and it's not for you, click unsubscribe. No problem, no harm, no foul. So let's say you didn't catch the mistake in time. You didn't make a voluntary disclosure. You've just been living your life and then one morning, brown envelope lands on your doormat. You open it, heart racing, and there it is. We're conducting a check into your self-assessment return. Now what? Well, you don't actually need to go through the effort of running away and creating a new identity for yourself. The truth is, how quickly you respond to them matters more than ever. As delays, vague replies, or complete silence, please don't ostrich. That can make things spiral out of control. This might surprise people, but HMRC doesn't just look at your numbers. They assess how cooperative and accurate you are once they get in touch. They even use a system called BRISC, B-R-I-S, short for Behavioural Risk Scoring, to monitor how risky you are as a taxpayer going forward. So if you respond late, fail to provide what they've asked for, change your story halfway through, that doesn't just affect this investigation, it flags you for future checks too. HMRC usually gives you 30 days to respond. If you do nothing, they'll escalate the check, often to a formal inquiry with much broader powers for them to dig deeper. And when I say broader powers, I mean broader powers. We're talking the ability to dip into your bank account and take whatever tax bill they estimated you owe, even if it's not completely accurate. And the best thing you can do, respond quickly, stay calm, provide clear evidence, be honest if something's gone wrong, and don't try to bluff your way through it. So here's the big picture. Whether you're making 5,000 or 500,000, it's all on record somewhere, and HMRC already have the data. They already know what the platform's reported, and they're already comparing it to what you've submitted. And now you know what they're looking for, you can stay off their radar completely.